The stock market has created more millionaires than almost anything else in history, but most people never learn how it actually works. Today, we're breaking it down into simple terms so you can understand the most powerful wealth building tool on the planet. So, what even is a stock? It's simpler than you think. A stock is simply ownership in a company. When you buy one share of a company like Apple or Tesla, you own a tiny piece of that business. Think of it like a giant pizza, where each share is one small slice. Companies sell these shares to raise money to grow their business, build new products, expand into new countries, or pay off debt. For you, it's a chance to own a piece of their success. You've probably heard the term IPO. That's an initial public offering. It's when a private company first sells its shares to the public, letting everyday investors like you and me buy into its future growth. Once those shares are public, they trade on massive marketplaces called stock exchanges, like the New York Stock Exchange or the Nasdaq. So why do stock prices move up and down all day? It all comes down to supply and demand. If more people want to buy a stock than sell it, the price goes up. If more people are selling than buying, the price goes down. Simple, right? But what drives that demand? Well, a lot of things. Strong company profits, exciting new innovations, economic news, changes in interest rates, and even just plain old investor emotions. The market is part math and part psychology. When you hear on the news that the market is up, they're usually talking about major stock market indexes like the S&P 500 or the Dow Jones Industrial Average. These indexes are just collections that track the performance of a group of large, influential companies. They give us a quick snapshot of how the economy and the overall market are doing. So how do you actually make money? There are two main ways. First, capital gains. This is when you sell a stock for more than you paid for it. Buy low, sell high. The second way is through dividends. These are cash payments that some companies share with their shareholders. Kind of like a thank you for being an owner. Over the long term, your money can grow exponentially through something called compounding, where your earnings start generating their own earnings. Of course, the stock market doesn't only go up. Prices fluctuate daily. It can be volatile. Fear, recessions, and global events can cause sharp, scary drops. But history shows that over long periods, the market has always trended upward. The key is patience. It's about ignoring the short-term noise to capture the long-term growth. Ready to get started? It's easier than ever. You just need to open a brokerage account, and many apps and online platforms let you start with just a few dollars. A great strategy for beginners is to keep it simple. Instead of trying to pick the next big winning stock, consider investing in a diversified index fund that tracks the whole S&P 500. This way, you own a small piece of all the top companies at once. Consistency is far more powerful than trying to time the market. Remember, the stock market isn't a casino. It's not gambling. It's ownership in real businesses that make real products and services. When those businesses succeed over time, you, as a shareholder, can benefit. Understanding how it works removes the fear, and when you remove fear, you can start making smarter financial decisions for your future. Thanks for watching. And don't forget to subscribe for more simple finance explainers.